While the general public kept their eyes glued to fluctuating price charts, the critical decision that will reshape the global financial landscape was finalized far from the trading floor, in the quiet corridors of Basel, Switzerland. The Bank for International Settlements, BIS, often called the central bank for the world's central banks, has quietly ushered in the final implementation stage of the Basel III Endgame regulations. This is not market chatter or an unverified rumor. It is a concrete regulatory mandate, set to take full effect the moment markets open on Monday. The decision was passed with little fanfare because its architects are acutely aware that it fundamentally alters the existing financial order. This new regulatory framework compels banks to completely reconsider how they account for gold and silver on their balance sheets. For decades, a paper certificate or a digital ledger entry promising metal was treated as being as valuable as the physical bullion itself. Starting Monday, that convenient fiction comes to an end. To grasp the magnitude of this shift, one must first understand the concept of bank capital requirements. Prior to this change, financial institutions could hold unallocated gold and silver, essentially paper promises and derivative contracts, and classify them as a safe, high-quality liquid asset. The updated rule, specifically regarding the Net Stable Funding Ratio, NSFR, now makes holding such unallocated paper metals both expensive and risky for banks. It actively penalizes them for maintaining short positions in the precious metals market. This powerful incentive forces banks into a binary choice: either acquire sufficient physical bullion to fully back their paper positions or exit the paper market altogether. The stated intention behind this regulation is to prevent a repeat of the 2008 financial crisis by eliminating systemic risk. However, in executing this goal, regulators have inadvertently ignited a fuse beneath the precious metals market. This rule effectively serves as the death knell for the kind of naked short selling that has artificially suppressed the price of silver for nearly 4 decades. Institutions like JP Morgan and Citigroup can no longer maintain enormous short positions without setting aside massive amounts of costly capital against them. The financial burden of manipulating the price has just become prohibitive. The cost of carrying these positions has skyrocketed overnight. We are already witnessing the preliminary effects. In the overnight markets, major banks are frantically unwinding their short positions to ensure compliance before the Monday deadline. The resulting buying pressure is the primary force that will drive prices upward. This isn't about speculative fever. It's about the cold, hard logic of regulatory compliance. Perhaps the most bullish aspect of this regulatory overhaul is the formal reclassification of gold, and by direct association silver, as a Tier 1 high-quality liquid asset. Previously, gold was categorized alongside riskier assets like equities. Now it is elevated to the same risk-free status as cash or U.S. Treasury bonds. This creates a powerful incentive for banks to acquire physical bullion as a means of fortifying their balance sheets. Their institutional posture is shifting from one of price suppression to one of asset accumulation. When the largest players in the financial system transition from being net sellers to net buyers, the price floor beneath the market is permanently raised. This dynamic perfectly explains the strange liquidity vacuum observed in the markets last week. Major banks withdrew their standing sell orders because they were anticipating this rule change. They had no intention of being caught in a vulnerable short position when the new regulations came into force. The market didn't halt due to a technical glitch. It paused because the primary market makers stepped back to recalibrate their algorithms and strategies for the new Basel III reality. The game has fundamentally changed from suppress the price to secure the asset. Large-scale industrial consumers such as Tesla and Samsung are also acutely aware of these impending changes. They understand that if banks cease to be reliable sellers of paper silver, the underlying price will inevitably rise to meet persistent physical demand. This is the driving force behind the recent panic buying we've observed in the industrial sector. They are racing to secure supply contracts and inventory before the banking sector enters the market as a massive new buyer, competing for the same finite pool of physical metal to satisfy their capital requirements. It has become a direct competition between factories and financial institutions, and there is simply not enough silver to satisfy both. China has already been operating in compliance with the spirit of these rules for months. The Shanghai Gold Exchange functions on a fully allocated physical delivery basis. With this rule change, the Western financial system is finally catching up. It is an implicit admission that the Chinese model, which prioritizes physical metal over paper claims, has won the philosophical argument. By passing this regulation, Western regulators are aligning themselves with the Eastern perspective, conceding that paper derivatives are a source of systemic danger and that physical metal constitutes the only true financial safety. Why should the average person care about an obscure banking rule? Because while this regulation makes the banking system safer in the long term, it simultaneously weakens the currency required to purchase the gold and silver that banks now need. To acquire this metal, banks will have to sell other assets, likely U.S. dollars and Treasury securities. This selling pressure pushes the value of the dollar downward. As gold and silver are revalued higher to meet their new status as Tier 1 assets, the purchasing power of the fiat currency used to price them must inevitably fall. The revaluation of gold is, by definition, the devaluation of the dollar. If you hold an unallocated silver account at a bank, this new rule represents a direct danger to your position. The bank is now financially incentivized to close your account or convert it to cash because holding your unallocated silver is now a capital liability for them. It is highly probable that we will soon see banks sending letters to clients stating, "We are discontinuing our precious metals storage program. Enclosed is a check for the cash value of your holdings." If you do not hold the physical metal in your own possession, you are at risk of being cashed out at the worst possible moment. You will not hear terms like NSFR or Basel III explained on the evening news. The concepts are considered too technical, too bureaucratic, and too dull for mass consumption. But this is the plumbing of the global financial system. The media will report on market volatility, but they will not explain its root cause. That root cause is a fundamental structural change in how banks are permitted to leverage paper assets. The era of infinite leverage concluded last night. This event is as significant as President Nixon's decision to close the gold window in 1971. In 1971, the world moved away from a metal-backed currency system. In 2026, with the implementation of Basel III Endgame, we are beginning the long bureaucratic journey back towards it. It is a slow-moving regulatory return to a gold standard, disguised as a routine update to banking rules. The central bankers understand that the global debt load is unsustainable. They are quietly preparing the lifeboats, and those lifeboats are constructed of gold and silver. With the banks stepping back from their traditional role of price manipulation due to the new cost structure, true price discovery can finally occur. We may witness extreme volatility in the short term as paper shorts scramble to cover their positions. However, the long-term trajectory is now clearly defined. The price must rise to a level where physical supply meets physical demand, free from the diluting effect of infinite paper claims. That equilibrium price is substantially higher than current levels. Because banks are now required to hold more capital against their activities, they will have less capacity to lend. This rule change will inevitably trigger a credit crunch throughout the broader economy. Securing a mortgage or a business loan will become more difficult starting Monday. This deflationary pressure on the economy will be met with inflationary money printing by central banks like the Federal Reserve, creating a classic stagflationary environment. In such an environment where economic stagnation meets high inflation, silver has historically been the best performing asset class. The intelligent course of action is to align your strategy with that of the banks. If the banks are being compelled by law to hold physical metal, then you should hold physical metal. If the banks are being forced to exit paper contracts, then you should exit paper contracts. Do not bet against the new rules. The prevailing wind is now blowing decisively towards tangible assets. They passed it. The rules have changed. Monday morning marks the official start of the Basel III era. The banks are scrambling to comply. The shorts are covering and the physical market is tightening. This is not a conspiracy theory. It is a documented regulatory reset. The paper game is over. The physical game has begun. For years, the London Bullion Market Association, LBMA, operated within a loophole that permitted unallocated gold to be counted as a high-quality asset. This allowed banks to lease the same physical bar of gold multiple times to different counterparties, effectively creating a paper pyramid scheme. Basel III closes this loophole definitively. It mandates that for an asset to qualify for Tier 1 status, it must be fully allocated and physically present in the bank's vaults. This forces the LBMA clearing banks into a desperate scramble for physical inventory. The era of fractional reserve bullion banking is drawing to a close. When London begins demanding physical delivery to satisfy these new ratios, the drain on global bullion vaults will accelerate at an unprecedented pace. The entire multi-trillion-dollar derivatives market is built upon the perceived stability of the banking system's collateral. By forcing banks to hold better, more tangible collateral, specifically gold and silver, Basel III makes trading derivatives significantly more expensive. we can anticipate a massive deleveraging event. Hedge funds that relied on cheap leverage to maintain short silver positions will be forced to close them, as banks will no longer extend credit at favorable rates for such purposes. This short covering rally will be driven by the fundamental mechanics of the banking system, not just by market sentiment. Sovereign wealth funds in the Middle East and Asia have been preparing for this regulatory shift for years. They understood that once gold was reclassified as a Tier 1 asset, its value would have to increase to support the global financial balance sheet. They have been front-running this regulation for the past 2 years. Now that the rule is active, we expect them to make public announcements regarding new significant allocations to precious metals. When a sovereign fund managing $1 trillion in assets moves just 1% of its portfolio into silver, the market impact will be explosive. While Basel III's primary focus is gold, silver benefits enormously by association. Historically, the prices of silver and gold have moved in tandem. As gold reclaims its status as the ultimate monetary metal for central banks, silver reclaims its parallel status as the ultimate monetary metal for the people. The gold-to-silver ratio will contract sharply as investors realize that silver is the deeply undervalued counterpart to the new Tier 1 asset. We are witnessing the stealth remonetization of the entire precious metals complex. Ironically, these rules, designed to make banks safer, are making them more vulnerable in the immediate short term. Many institutions do not possess enough physical metal to meet the new requirements. To acquire it, they must purchase it on the open market, which drives the price up and exacerbates the losses on their own short positions. This creates a potential doom loop where the very act of complying with the law could financially injure or even bankrupt a bank. Central banks, like the Fed, may be forced to print money to assist commercial banks in purchasing the necessary gold. This outcome is inherently inflationary. There is a fundamental conflict emerging between the hard money implications of Basel III and the push for central bank digital currencies, CBDCs. While one faction of the global elite advocates for digital control, the banking regulators are simultaneously pushing for physical collateral. This suggests a significant split within the establishment. Commercial banks appear to want gold as a foundation for survival, while some central banks push for CBDCs as a tool for control. In this war between factions, the individual investor can emerge victorious simply by holding the asset that both sides ultimately require, physical metal. With the new rules come new, stricter audits. Regulators will be conducting physical inspections of vaults to verify that the metal actually exists. There is a strong suspicion that many banks have been counting leased metal as their own proprietary assets. When the auditors arrive this quarter, the extent of this double counting